to OVG Talks. My name is Bernardo Bruzzone, and I'm the regional editor for Oxford Business Group in Africa. Thank you for joining. Today, we'll be talking to members of the African Private Equity and Venture Capital Association, AVCA, on how can PE stimulate growth in the country. So my first question is for Abi Mustafa Madouakor, newly appointed CEO of AVCA. Abi, what is your outlook for private equity in 2021, and what role do you see for PE during this current pandemic scenario?
2021 will not be without its unique challenges, but there is a widespread hope that this year will mark the beginning of economic recovery and the transition to a smarter future driven by data, technology adoption, and cross-country and cross-sector collaboration. In terms of Africa's private equity and venture capital industry, we expect the following trends to continue being prevalent. Firstly, venture capital activity will continue to grow as Africa's startup ecosystem continues to attract attention from both local and international investors. Africa's VC landscape has gradually evolved to become a recognized and definable investment theme, simultaneously attracting international investment to the continent, while also encouraging the development of local venture capital firms and homegrown financing solutions. According to AVCA's inaugural Venture Capital in Africa report, published in June 2020, North American investors represented 42% of the total number of investors deploying capital in VC investments in Africa between 2014 and 2019. This was followed by European-based investors at 23%, African-based investors at 20%, Asia-Pacific-based investors at 8%, and Middle East-based investors at 6%. In 2021, we expect to see an increase in the number of VC deals across the continent, building on the success of the past 6 years. We also expect to see increasing interest in defensive sectors such as healthcare. In 2020, we saw a number of notable deals in Africa's healthcare sector, as African fund managers prioritized identifying and pursuing opportunities in businesses that were focused on COVID-19 responses. Some examples include the Mediterranean Capital Partners investment in MetaMed, the largest platform of diagnostic image centers in Egypt, Jordan, and Saudi Arabia. Another example is the $3.7 million Series A investment round in Kenyan health tech startup Elara Health, which was led by TLCom. We expect to see further investments in the health ecosystem to improve access to medical equipment and healthcare facilities in 2021. Alongside healthcare, there is a growing appetite for opportunities in technology-enabled businesses. Information technology has substantially impacted the growth of other industries such as finance, education, and agribusiness. In the first half of 2020, information technology was one of the most active sectors in terms of deal volume, rising from 8% in the first half of 2019 to 17% in the first half of 2020. The necessity of tech-enabled innovation will continue to grow following the COVID-19 pandemic, and therefore remains a high interest sector for private equity investment as Africa begins its economic recovery. Another theme we foresee is impact investing, which will feature more prominently in the years to come. An increase in appetite for impact and sustainability from governments, consumers, and LPs will play a significant role in enabling more fund managers to integrate ESG policies in their investment philosophies and to think about how they can best deliver impact. Finally, cross-border collaboration will be further encouraged. It's now a month since the AfCFTA launched to leverage regional value chains and encourage greater capital flow across Africa by removing trade barriers. This might be the most important development in trade history, as the AfCFTA opens up opportunities to boost local and regional manufacturing capacity, bridge funding gaps across the continent, and create more value. In this environment, we expect private equity and venture capital firms to continue to support Africa's economies weather the storm in 2021 and beyond as they work to address the economic fallout from the pandemic.
Yes, definitely ESG and the Continental Free Trade Agreement are two topics that we're going to be following up very closely this year. Next question is for Tokumbo Ismail, Managing Director of AVCA Capital. Tokumbo, how do you see private equity as a funding option for essential services, especially with COVID-19 making this funding gap more evident in Africa?
Indeed, private equity does have a large role to play as we continue to manage the current crisis and begin to emerge from it. COVID-19 has indeed spotlighted the challenges of access, affordability, and underfunding of essential services such as health, education, and finance. In health, the lack of adequate facilities, PPE, and data have resulted in needless deaths. In education, the lack of digital infrastructure and access to affordable options have resulted in stolen hours of education from those that need it most, widening the gap between the haves and the have-nots. These intractable problems require innovative solutions at scale. At Alethea, we are financing some of these solutions, such as smart energy, logistics, and finance, enabling small business and ordinary folk to access the necessary tools, education, and care to reach their full potential. In spite of the pandemic, clients of our digital lender, Lydia, have been able to secure the financing required to keep their businesses afloat. Likewise, our payments company, Paga, has ensured that retailers and customers could continue to buy and sell goods and services through digital cash transfers and cash-in, cash-out neighborhood agents. And Max, our logistics company, has facilitated the movement of essential goods and services from point to point, even when people couldn't move around. These are just some of the examples that reinforce for us the need to be intentional with investments that develop essential sectors to boost social and financial outcomes. Patient and impactful private equity that finances, supports, and scales these solutions for financial and developmental returns will be the vanguards of pathways to resilience in essential services and, by extension, African economies. And of course, when the African continent is able to be resilient, indeed it will reach its full potential, and so will its people.
Now we will have Ziad Zlati, Executive Co-Founding Partner at Africa Invest, on what has been the most significant challenges for portfolio companies since the beginning of the pandemic, and what role have PE firms played in terms of providing guidance and support to different sized companies.
It is almost a year now since the pandemic has started. The vaccine is being rolled out in the developed world with little visibility on when it will be available in our continent. Thanks God, the overall impact of the pandemic in Africa remains below what we have seen in other emerging markets like Latin America. And some African countries have been quite resilient and have even shown a growth in their GDP in 2020. The different governments in Africa have reacted in a different way to the pandemic, from full lockdowns in a few countries to curfews and no actions in several. Some have also been proactive in providing support to the SMEs by putting in place financing programs and or imposing on banks to provide a moratorium on debt payments for 3 to 12 months. But these programs cannot be compared to the billions or trillions of dollars that have been extended by most of the countries in the developed world to their consumers and their SMEs and even larger companies. The impact on SMEs in Africa has been different from one country to another and from one industry to another. Those in general that have commodity-linked inputs have been positively impacted as commodity prices have fallen in 2020. Most of the companies in the food businesses, for example, have been quite resilient. This also includes companies that supply them, like plastic containers, manufacturers, and other inputs, likewise for distribution and logistics companies. However, in 2021, it will be a different story. Prices of commodities, but also logistics, are going up again, as Asia is back to almost full production. Innovative companies in the fintech, logistics, edutech, and health tech have also been among the winners, as the pandemic has accelerated their growth and the adoption by the African population of these innovative ways to get service or product. In 2021, African SMEs should still face major challenges of liquidity and suffer from a lack of visibility, As a PE firm, we will be there to provide the needed support and push them on a selective basis to proceed with the investments and growth plans that they had put on hold in 2020. 2021 should be the year for the companies that were resilient to reinforce and consolidate their position in their own market and seek to grow in new markets through organic growth, but mainly build-ups. And as a PE and VC firm, we will be there to support such companies.
Thank you, Ziad. Now, last but not least,
Alexis Code.
Managing Partner at Adenia Partners.
Alexis.
For many PE funds, the African exit environment has been considered somewhat challenging, and there have been some concerns regarding the impact of the pandemic on the exit landscape. What is your point of view in this regard, and what advice would you give to fund managers that are facing challenges finalizing exits?
Well, first of all, thank you to offer the opportunity to Adenia to talk about its exit. And I think one of the exits we are quite proud of is the exit of Mobilac that we did on April the 1st, 2020, so in full lockdown. We invested in this company in 2014. It's the typical investments that we like at Adenia. Strong brand, dominant market share, so strong pricing power, excellent distribution network, and also profitable. And during the time of the investments, we were able to pull lots of levers to create value. The first one is we hired an entirely new management team. The second is the fact that we upgraded the factory. We made significant investments. And maybe the last, that thanks to the investments, we brought this company to international standards. And we decided that after 5 years, it was time for exit. So we launched a competitive process. And at the end of this process, we were quite proud to sell the company to AkzoNobel, which is the third largest chemical and decorative paints company in the world, that bought the company on the 10 times multiple, whereas we acquired the business on the 7 times multiple. So 2.5 times multiple was increased due, I think, to the value creation process that was done by Adenia, and also by the increase in EBITDA that was quite significant. So the end result was a 3 times cash on cash return for Adenia. So a good end result. The second question that I think you wanted me to talk about was the advice to on exits. So, well, first of all, I would say that it's difficult to give any advice on exits. At Adenia, we've done 25 investments and 15 exits. Our average holding period is 5.5 years, and we try to stick to this holding period to make sure that we give the money back to our LPs on time. Maybe I would just give you a few advice. Well, at least those which I feel are the most important. The first one is to think about the exit at the time of any investment. It seems very obvious, but the more you are ready, the more you project the way the company you want it to be at the time of the exit, the more the chances that you will succeed. So think early on. If you need to make changes in strategy management, you need to do them quite early during the time of the investment. The second is maybe linked to Adenia's strategy. We like to have control, and it's true that timing is often very important. I would say timing is everything, and being in control is always more easy to push on the exit button when you're controlled and when you're a minority shareholder. Third advice is be prepared. All the financial information, all the legal information, all key contracts need to be ready to be inspected by external parties. So everything needs to be well prepared in advance. If you need to do a VDD, do it. But think in terms of planning and ahead, and make sure that the information, especially the financial information, is of good quality. Maybe another advice would be to take the best advisors. Financial advisors, when they are good, they do have international networks. They can speak directly to key decision makers in large organizations, and definitely this has some value especially if you are looking for international buyers. And maybe, yes, last one, when you have a good asset and you're buying, you need to act very decisively and very quickly. When you're selling, I think you need to move a little bit slower. You always want to be in a position to have two motivated buyers. That's obviously the ideal position to negotiate, but usually it takes time. So I would say take your time when you're selling to get the best deal. Thank you very much for offering the opportunity to Adenia to present this exit of Mobilac and to talk about the exit processes in general. Thank you.
This was OBG Talks by Oxford Business Group. I hope you enjoyed this vidcast.